Welcome back to MonsterInvest. I'm your host, Daniel. There's an old saying on Wall Street that you have probably heard 1,000 times, but today we are going to actually dissect it. The quote is from the Oracle of Omaha himself, Warren Buffett: "Price is what you pay, value is what you get." It sounds simple, right? Just a catchy one-liner. But the gap between price and value is the most dangerous and profitable territory in finance. It is where fortunes are made and where they are lost. It is the difference between a gambler and an investor. In the short term, the market is like a voting machine. It's a popularity contest driven by hype, fear, and headlines. But in the long term, it is a weighing machine. It measures the true substance of a business. Our job today is to stop voting and start weighing. Imagine for a moment you're walking down a street in a new neighborhood. You see a house for sale. The sign on the lawn says $1 million. Now, I want you to ask yourself, is that house expensive or is it cheap? If you just look at the price tag, you have absolutely no idea. You are operating in the dark. If that house is a crumbling shack with a leaking roof in the middle of a swamp, $1 million is a robbery. You'd be throwing your money away. But if that house is a 10-bedroom mansion with marble floors in the heart of Beverly Hills, $1 million is the bargain of the century. You would beg, borrow, and steal to buy it immediately. The stock market works exactly the same way, but instead of houses, we are buying businesses. Every day, tickers flash green and red numbers at you on your screen. Amazon is at this price, Tesla is at that price. But those numbers, those squiggly lines on a chart, are just the price tags on the lawn. They don't tell you if the house is a mansion or a shack. They only tell you what other people are willing to pay for it right now. To figure out the truth, you need to ignore the sign on the lawn. You need to open the door, check the foundation, look at the plumbing, inspect the electrical wiring, and evaluate the neighborhood. In the investing world, we call this home inspection, fundamental analysis. Today, we are going deep. We are going to learn how to strip away the hype, ignore the market noise, and figure out what a company is truly worth. We are going to turn you from a spectator watching price tags into an inspector valuing the property. To do this effectively, I don't want to just throw textbook definitions at you. I want to tell you a story. I want you to imagine a friend of yours. Let's call him Jack. Jack is that friend who always has a new million-dollar idea. He comes to you today, eyes wide with excitement, and says, "Daniel, I have this amazing business called Jack's Super Burgers. It's the next big thing. I want to sell you a share of it." Now, Jack is a charismatic guy. He's a great salesman. He tells you the burgers are delicious, the logo is cool, the Instagram page has thousands of followers, and everyone in town is talking about it. He says, "The share price is $100. Get in now before it goes to the moon." Your emotions might say, "Do it." Jack is confident and the burgers are good. But your wallet should be terrified. How do you know if you should give Jack your $100? You need to perform fundamental analysis. And it comes down to three main pillars, or as I like to call them, the three truths. Truth number one, the income statement. You look Jack in the eye and ask, "Okay, the burgers are tasty and the brand is cool, but are you actually making money?" Jack hands you his income statement. This document tells you the story of profit over a period of time. You look at the top line, revenue. That's the raw cash coming in from selling burgers. Let's say Jack sold $1 million worth of burgers last year. That sounds impressive, right? $1 million business. But wait, revenue is just vanity. Profit is sanity. You look down the list at the expenses. The cost of the premium beef, the artisanal buns, the rent in a trendy district, the electricity, the staff wages, the marketing budget. After you subtract all of that, you get to the bottom line, or net income. If Jack sold $1 million in burgers but spent $1.2 million to do it, Jack's Super Burgers is technically losing money. For every burger he sells, he is digging a deeper hole. It doesn't matter how cool the logo is, the business is bleeding. In fundamental analysis, we are looking for the quality of earnings. Is the revenue growing? Good. But is the net income growing faster? That's better. We want to see that for every dollar Jack takes in, he keeps a healthy, consistent chunk of it as profit. We call this the profit margin. If his margin is razor thin, one bad month could bankrupt him. Truth number two, the balance sheet. The income statement told us about the flow of money over the last year. The balance sheet is different. It is a snapshot of the business's health at a single moment in time. Think of it like a medical checkup or a photo of your bank account right now. On one side, you have assets, what the company owns: the grills, the fryers, the building, the inventory of potatoes, and most importantly, the cash in the register. On the other side, you have liabilities, what the company owes: loans from the bank, money owed to meet suppliers, rent due next month. Let's go back to Jack. You look at his balance sheet and you see he has $500,000 in assets. Great, but then you look at his liabilities and you see he owes the bank $2 million. This is a massive red flag. This company is drowning in debt. We call this being highly leveraged. Even if he's selling a lot of burgers, the interest payments on that debt might crush him. If interest rates rise, or if sales dip for just 1 month, the bank could come and take the keys. In fundamental analysis, we love companies with fortress balance sheets, lots of cash, very little debt. It means they can survive a storm. If a recession hits, Jack goes bankrupt, but the company with the fortress balance sheet survives and maybe even buys Jack's store for pennies on the dollar. Truth number 3, the cash flow statement. This is my personal favorite. If the income statement is the head and the balance sheet is the body, the cash flow statement is the blood. The phrase you need to remember here is, cash is fact, profit is opinion. That sounds strange, doesn't it? How can profit be an opinion? Well, accountants use rules like depreciation and amortization, which can manipulate the net income number. They can make a loss look like a profit on paper. But the cash flow statement is the truth serum. It tracks the actual physical dollars moving in and out of the company's bank account. You can't fake cash. If Jack tells you, hey, I made a profit of $100,000 this year, that looks great on the income statement, but you check his cash flow statement and see that his cash from operations is negative. Why? Maybe he made sales on credit and hasn't collected the money yet. Maybe he spent too much buying new fancy fryers. That's called capital expenditure, or CapEx. We want to see free cash flow. That's the golden number. That is the cash left over after the business pays for everything it needs to maintain itself. That is the money that can be used to pay dividends to you, buy back stock, or acquire other businesses. If a company doesn't generate free cash flow, it's on life support. Now let's step away from Jack's Burgers. Let's apply this to the big leagues. Let's create a fictional tech company called Cloud Titan. You wake up one morning and check the news. Cloud Titan's stock price has dropped 20% in a single month. The headlines are screaming. Tech sector is dead. Sell everything. People are panic selling. The price tag on the lawn has been hurriedly marked down from 150 to 100. Is it a disaster, or is it a bargain? Most people run away. You put on your fundamental analysis hat. You look at the income statement. Revenue has grown 15% year over year for the last 5 years like clockwork. Margins are increasing. They are scaling up beautifully. You look at the balance sheet. They have zero long-term debt and $2 billion in cold, hard cash sitting in the bank. They are a financial fortress. You look at the cash flow. They are printing money. Their free cash flow is growing, and they are using it to buy back their own stock because they know it's cheap. So why did the stock drop? Maybe just because of market sentiment. Maybe investors are scared of a rumored recession. Maybe an analyst downgraded the sector. But the fundamentals tell you the house is a mansion, and it's being sold for the price of a shack. This is where you find the concept of intrinsic value. Intrinsic value is what the company is mathematically worth based on the cash it will generate in the future. It's a calculation, not a guess. If your calculation, based on those 3 pillars, shows Cloud Titan is worth $150 per share, but the market is emotionally selling it for $100, that $50 gap is your margin of safety. That margin is everything. It represents your profit potential, but more importantly, it is your protection against being wrong. If you think it's worth $150 and you pay $148, you have no room for error. If you pay $100, you can be a little wrong and still make money. But wait, before you rush out to buy Cloud Titan, there is one final piece of the puzzle. The numbers are the quantitative side. Now we need the qualitative side, the things you can't find on a spreadsheet. We call this the economic moat. Think of a medieval castle. Inside that castle is the company's profit. Outside, there are barbarian hordes, competitors trying to storm the castle and steal the profit. To protect the castle, you dig a deep moat around it filled with water, spikes, and maybe a few crocodiles. In business, a moat is a durable competitive advantage. If Jack's Burgers is just a generic burger joint, a competitor can open next door, sell burgers for $1 less, and steal his customers. He has no moat. His castle is defenseless. But look at Cloud Titan. Do they have a moat? Maybe they have a network effect, like Facebook or Instagram, where the product gets better the more people use it. It's hard to leave because all your friends are there. Maybe they have high switching costs, like enterprise software. Once a company installs Cloud Titan's system, it is too expensive and painful to switch to a competitor. They are locked in. Maybe they have a brand moat, like Coca-Cola or Apple. People pay extra just for the name. If a company has a wide moat, it can protect its profits for decades. If it has no moat, those profits will eventually be competed away to zero. And finally, look at the management. We call this skin in the game. Does the CEO own stock in the company? If the stock price goes down, does the CEO lose money too? Or are they just hired guns collecting a paycheck? You want a management team that thinks like owners, not employees. So when you combine the quantitative side, the income statement, balance sheet, cash flow with the qualitative side, the moat and management, you get the full picture. You are no longer gambling. You are investing. You are not betting on a ticker symbol. You are buying a piece of a business that you understand. Now I know we covered a massive amount of ground today. We went from buying houses to burger joints, from detailed financial statements to economic moats and medieval castles. It's a lot to digest. So before we close out this episode, let's recap. I want to give you a concise summary of exactly what you have learned today. Here are the key takeaways to carry with you. First, price is not value. Never confuse the two. Just because a stock is cheap, low price, doesn't mean it's good, and just because it's expensive, high price, doesn't mean it's bad. The market is often irrational. You must look under the hood. Second, rely on the 3 financial pillars. The income statement tests for profitability. Are they actually making money on sales? The balance sheet tests for health. Can they survive a crisis without drowning in debt? The cash flow statement tests for reality. Is real cash entering the bank account? Third, calculate your margin of safety. Try to buy $1 worth of assets for 50 cents. That gap is your insurance policy against bad luck and bad math. And finally, never ignore the moat. Numbers tell you the past and present, but the moat tells you the future. A strong competitive advantage is what keeps a company alive and dominant for decades. Fundamental analysis isn't about being a math wizard. You don't need a PhD in calculus. It's about being a business detective. It requires patience, discipline, and the ability to control your emotions when everyone else is panicking. But it is the surest path to building true, long-term wealth. Thank you for tuning in to Monster Invest. If you found value in this episode, make sure to hit that subscribe button. Until next time, keep analyzing, stay rational, and I'll see you in the markets.